It's time for that weekly market wrap up, and I'm joined as usual by Roger Scott. Roger, how are you doing?
I'm doing great. Thanks for having me on, James.
Hey, Roger, it's great to see you as usual. Roger, this week has been, as I've been telling my subscribers, the most fascinating week in capital markets yet. Very emblematic of a seismic shift in the whole landscape. A paradigm shift is underway. We now have huge battles of social media influencers pitted against each other, driving equity prices and liquidity into stocks and other assets that are not really deserving of the attention, the liquidity, or the rise in value that they experience. Yet, you benefited from this phenomenon earlier this week, as you mentioned to us in the Monday morning roundtable, as it pertains to GameStop. I'm assuming that you didn't wade back into that fray. And give me an overview of what you see as the sort of the play-by-play of what happened this week.
James, I'm going to tell you my opinion is actually a little bit different than the Main Street opinion out there. And I'm very discouraged, and I'm not happy about any of this, because I believe this this goes to the depth of the sanctity of the U.S. stock market, and is flirting with institutional irresponsibility on a grand scale. I believe there's a lot more to this short squeeze that we're seeing on these stocks. I believe this is not just social media. I believe, and I'm going to tell you something. I'm the last guy. I'm not a conspiracy theorist. Okay, I'm not the guy that thinks that a million people were conspired to kill Kennedy. I don't believe Elvis is still alive. I'm not that guy. I'm a very mainstream guy. So for me to say this, it's just not. I'm not a conspiracy theorist, okay? And I genuinely believe if this was just a bunch of Yahoo retail traders on Yahoo doing on Reddit doing this, I believe the significance and the impact of what we are seeing with these stocks would not be as widely felt, and it wouldn't be as broad, because I don't believe the amount of capital that they're throwing into this stock on a daily basis for 5 days now is indicative of retail traders. I believe once the SEC gets to the bottom of this, they're going to find that even if it was on a retail basis, there is a big conspiracy here. There were some people who had inside knowledge of strike prices that these institutional investors held. I do not believe this is just a random incident to short squeeze GameStop. I don't believe it. Too many things are happening, and too much of it is happening. You're talking about wrangling some of the biggest hedge funds, and I'm going to tell you, I don't believe a random retail investors just decided to do it. No, I think if that was the case, we would have seen more things like that. Also, we're seeing the same thing on a lesser scale with AMC stock, with several stocks. I actually have a list, and I've been talking all week about these stocks. We got EXPR, KOSS, BBBY, AMC, Space, SPCE. It's happening broadly. So I don't believe this is just a random, isolated retail traders Yahoo doing their thing. There's more to it than that. And I think what's going to happen is, I think the SEC is very busy right now, going through these trades, getting the IP addresses of these traders, matching them with the IP address of these Reddit guys. And I'm going to tell you, within a month or so, we're going to get to the bottom of this. The biggest problem, though, is every time things like this happen, the investors, the traders, end up paying the price. For example, the 25,000 day trading rule for day traders. What do you think that started? This type of shenanigans started that as well. Every time something like this happens, it happens once, it happens twice, SEC goes tough on everybody, and we end up paying the price down the road. So, do I believe this is just this is a change in in sentiment and in change of how retail investors are behaving, and something we're going to be seeing from now on? Absolutely not. Absolutely not. I think there's a lot more to this. And I think we're going to see some criminal elements involved when it's all said and done. That's my opinion. And I think there's gonna be a shakeout as a result of this.
Sure. Let me ask you this, Roger. Do you think the criminal element exists solely on the social media slash Wall Street bets slash Robinhood side, or is the criminal element also being examined on the hedge fund side?
No, I think it's more on the social media brokerage side. I think that the brokerages were too irresponsible and didn't do due diligence when allowing traders to put on some of these positions or take off these positions. That's number one. So I think there's a lot of responsibility here with the brokerages. I mean, to allow GME to be a short interest of 130%, was somebody checking short float? Did they check that they had shares available? I think there's going to be, and again, it may not rise to the level of intent, but we're talking about gross negligence, recklessness for sure, 100%.
Yeah, so
This is
this
not.
is what excites me about this entire episode is that it highlights the fact that, in my estimation, at least 50% of the short activity or the short interest in a lot of these equities is naked, and that there is a complicity or duplicitousness among the SEC and the largest hedge funds, where they look the other way to the fact that these funds are trading largely naked. And the short strategists are notorious for generating hugely manipulative content that they then distribute through multiple mainstream news channels to drive prices lower and help them achieve their financial objectives. And now they've got these upstart social media guys doing the opposite on the long side, but targeting them directly and using. And now the SEC is coming out with the argument that, oh, the brokerages and the traders in this environment need to be examined. There's no discussion about the sort of the incumbent hedge funds and their practices, even though, for me, the conspiracy has been long underway in that ilk far before the social media phenomenon came along.
Well, and yes, that this could be a competing hedge fund using algos to snip these guys off, and that's my point. That's exactly what I'm saying. If you remember when we started this conversation, I said that if this was happening for a couple of hours, okay, maybe a session, okay, I could see, a bunch of Yahoo guys on Reddit got together and they did some Yahoo stuff, and then the stock got halted, and that's the end of that. This has been going on for 4.5 days now. You can't. What do you think? You got these retail guys with their $500 account? Come on, let's be real here. There's something here that we're not seeing the full picture here. That's my point. But I wouldn't be surprised if what you're saying is 100% true, but on a mass scale that we haven't seen before.
So let me ask you this, Roger. I've been telling my subscribers, a lot of them have been saying, well, how come we aren't in these trades? And I've been saying to them, well, these trades this is not a strategy that you can say, okay, we're going to do this strategy now, and here's how it works. This is not a strategy. This is it's a manipulation, whether by random, by organic, or whatever, but we're never going to try to catch that. We might catch the momentum as a result of our analytical infrastructure, as you did perfectly with the outset of the GameStop trade. You did 250% trade for your subscribers, and that's the extent of our involvement in that sort of universe. We're not going to join Wall Street Bets and start trying to figure out what they're going to do next.
No,
and get in front of that trade, are we?
No, not at all. And as a matter of fact, you brought up two really good issues. First of all, we got out like 72 hours before all these shenanigans started, and I had absolutely no interest in any of this. I'm going to tell folks out there something, because you brought up a very good point. No, we do not trade these strategies at Wealth Press, although we may trade the reaction following what happens. In other words, I will never trade or try to make money from a short squeeze because you're gambling. There's no predictability. The risk to reward ratio is way too high. You're better off just going to Las Vegas because at least you'll get comped and you may get a couple of drinks. Okay. So really, I've never ever been interested in trading that way. To me, it's just pure gambling, and I'm not a gambler. Even when I go to Las Vegas, I would go there for concerts. It's just not me. And I wouldn't encourage any of anybody following anything I do to get on this train, because I believe you're putting yourself in a lot more, in a very dangerous environment. And you just don't need to be there. You should only trade when the cards are favoring your position, when you have an edge. I don't see anybody getting an edge here. I don't even know what the hell's going on here. And it's going to take a while for us to all figure it out. So my advice is to stay away from it. With that said, I believe a lot of times after these short squeezes are over, when the short covering stops, when Reddit stops talking about it, there's an opportunity where the price of the stock goes so high and gets so out of whack to reality that sometimes buying puts and watching it go to fair value is an ideal trading strategy. So while I do not advocate any of this buffoonery, I call it, that's going on right now, I discourage it. As again, I think this is a crack to the sanctity of the U.S. stock market. I take this stuff very seriously because ultimately the public is going to pay for it years down the road with stupid regulations that restrict our activities. And I'm being as blunt as I can. I have very negative opinion about this. So the only thing I would do is discourage you guys from doing it and just walking away from it. But once it's said and done, you could see these short squeezes and you could see what happens after the fact. When the volume and the volatility goes back to normal, there's a good 2 to 3 week window from the point where the stock just kind of freezes and you know that there's just no action, volume comes back to normal, but it's still a while away from reaching its fair value. And that's a great opportunity to take advantage of them. And I actually have 3 stocks that I have target prices for that have recently gone through a short squeeze. So again, please do not engage in the process of the up. Don't try to guess how far they'll go. Ride them on the way down. So I have a price target on 3 stocks. The first stock is KOSS. I have a $3 price target on it.
What's it trading at now?
Oh, it was trading somewhere between 50 and 80. It's still on the upside. Again, I would wait for all this craziness to be over, buy a put, and ride it till $3. And I'm looking at puts that are expiring about a month from now. So end of February puts. I believe there's an expiration. Don't quote me on this, but I think it's on the 26th of February. Then another one, IRBT, and I'll tell you where they're trading right now. I could pull them up easily. So KOSS, let's see here. KOSS is now trading at, it's up 52% right now. It's at $63, up $21. Fair value for this stock, $3. Wait till this craziness is over and then buy a put if you feel like it, but don't get into this thing while it's next one. IRBT, I am recommending yesterday I recommended a 125 strike price put, and the target here is $85. I think the stock is going to go down to about $85. So there's a good amount of value there. And then lastly, EXPR. It's currently trading at about $6 per share, and my target on that one is $1.
So if this is going to be a persistent phenomenon, let's say the SEC steps back and says, well, okay, fair is fair. We're not going to overregulate. It's up to the brokerages to, they're taking on the counterparty risk. The chairman of International Brokers was on CNBC saying that they place limits on the trading in the stocks mentioned in the Wall Street Bets forum because he was concerned about the ability of the counterparty risk inherent in the clearinghouse's ability to fulfill transfer of payments for lost money because their clients might not be able to, pay their bills if they lose money. And so that was the excuse that he gave. And and then the Robinhood CEO came along and said, well, we have to protect the integrity of our marketplace for our customers. And I thought, well, that's interesting. They're protecting their customers from the short side, but not from the long side.
Exactly.
A little bit odd. But so, I mean, the interesting thing to me is this phenomenon constitutes a fundamental event in the price formation of an equity, because the ability of influence to create momentum based on mass hysteria is a tried and true fundamental factor. Headline-driven hysteria driving prices higher is a time-honored methodology that the SEC just basically anoints and gives its blessing to, regardless of whether it turns out to be true or not. If a reporter gets the story wrong and has no interest in the equity, it's just bad reporting, or what we now call fake news. If the journalist actually has a secret interest, it's stock manipulation. He's going to jail. Regardless, these are fundamental factors now. And in the case of GameStop, essentially GameStop is a company that's going out of business. And the short universe had gone all in on GameStop to the short side because nobody goes and buys their games in a cartridge fashion at a store anymore. You download them. There's no game there for them. So no matter how high the price of GameStop goes, this thing's worth what it was just before these guys got involved. And that's where it's going. So fundamentally, we're now faced with this opportunity where this currently $315 stock is definitely going back to $8. So there's the play. And that's
the play
with costs, IRBT, iRobot, and Expressing. That's the play. Take the fundamental and turn it into an opportunity that, hey, we're going to profit from that all day long.
Exactly.
Okay, great. What do you see happening with GameStop trading at 310 right now?
I think it's going to be halted, and I think there's going to be longer halts. And I think the SEC over the weekend is going to spend some time, and as early as next week, we're going to start hearing more info. Meanwhile, I think more brokerages are going to start restricting it, and I think investment brokerages may start freezing it in the retirement accounts as well, which would be really bad. Because right now all we're seeing is these Robinhood and swing trading type of brokers. We haven't seen really large banks, institutions do that. So if it starts bleeding to the clearing firm level, we may really start, because remember, all these brokerages the clearing firms are all banks. So if the banks like Pershing's and so forth starts getting an impact, we may see banks starting going out of business, or security companies, surety companies being impacted. So I want to see the extent of this. But honestly, I am shocked and surprised that the exchange that just did not halt the stock and on Tuesday or Wednesday. I'm surprised that it's still trading. It really shocks me. And I'm not happy about this. I don't like this, because this is turning Wall Street into a farce. And it's like going into a bank and seeing a party there. It doesn't feel secure. This is what this does to the exchange.
It's funny. So I've been monitoring wallstreetbets to see, what's their next trade. I want to test now their power, and the loudest equity, the loudest symbol that they've been broadcasting in the last 24 hours has been SLV, which is the silver ETF.
Yeah.
So I start watching the CFDs on silver. I start watching the silver ETF SLV, and I start watching the the ProShares Ultra Bull, which is a 2x AGQ, and silver's up like it's up to $2 on the day so far.
Yeah,
which is like 10%.
yeah, it's going to be very hard with an ETF because remember, the ETF price is driven by the actual commodity, by the actual
Right.
physical asset. The ETF is just a proxy. So if it gets too out of whack, the arbitrage opportunities are going to be instant on it because you can go and buy the future. So, so that's going to be very tricky, very, very tricky to manipulate. I don't think they're going to have a chance on that one. That's no GameStop.
Right, right, right. I thought it was interesting that they would choose a
Yeah,
commodity like silver. And it
right.
was interesting. The reason, the rationale behind that bet was because they say they're putting out this thing that silver is the most manipulated commodity in history, which is arguably true. There have been multiple attempts to corner the market in the past, which have largely resulted in a failure to some extent or a success in the case of the Hunt brothers, but an ultimate failure because you can't corner a commodity market for any period of time.
No, no. In 2006, I had the largest corn position in the world 3 times, and the
Really?
CFT and yeah, and the CFTC called me. It was for a fund. It was for a Canadian client. Funny enough,
Wow.
interestingly enough, coincidentally enough, and we had an option position, and when you have an option position, the deltas fluctuate. So you can go over position limit, under position limit, over position limit, under position limit, just by the underlying asset shifting. It's not a fixed. So literally, they would send me a letter saying you're over by 2,500 contracts. If you don't liquidate or offset this position within an hour, we're going to do it for you at the market, and we're going to be fining you X amount of money for every minute that you have it on. And it's bad. It gets, and that's you never want that. I think it happened to us 2 or 3 times in 2006. But yeah, the CFTC they're going to be on that like that. Nobody's going to manipulating the global silver market. My opinion, by the way, this is just an opinion. If you were to ask me what the most manipulated commodity was, I would, and this is just a guess, I would say it would be orange juice. Right now, the best thing to do would be not to do anything. Well, I'll tell you why. Well, let me go through the whole thing. We're right now in the middle of earnings. We have reported about 150 out of the 500 S&P 500 stocks. Next week and the week following are still very big flows.
Right.
Volatility is running amok right now. More importantly,
yesterday it spiked from 24 to 37 and change, and now it's trading at 30. That's sort of danger zone, isn't it?
We're in danger zone on volatility, but what's even more dangerous is the fact that the Dow Jones Industrial is right now breaking the 50-day moving average to the downside. And that is extremely in line with the narrowing of the momentum, which is what I was talking about last week with you, and talking about how sentiment indicator, divergence indicators, my technical studies, number of stocks above certain levels, everything is pointing to a bumps in the road. And as you could see, we are seeing them right now. I don't recommend traders have very big exposure during earnings season. And with volatility right now at about a 50% increase, you really don't need to have a lot of exposure right now. So if you are exposed, make sure you hedge yourself. Hedge yourself with either a volatility or a bond. Because if the market really crashes through the 50-day moving average, and I don't care what bonds are doing, they're going to rally from that point, especially the long bond. So TMF, triple leveraged ETF, or TLT, or VXX, I think those would be the best assets to have in your portfolio. So reduce exposure in individual stocks, increase exposure in defensive assets like bonds and volatility, and try to stay out of trouble. Don't look for adventure right now. Don't look at this volatility as a opportunity to make money. Look at it as a risk on opportunity. The cards are not in our favor right now. So the best thing to do is to just sit tight and hold, especially with what we're seeing right now. There's a lot of monkey business going on. And if you go to a nice restaurant and the people next to you are, doing drugs and being a foul, what do? You walk out. That's right. You don't want to be part of this right now. Hey,
Right.
there's no position is a position. Just remember that. So,
Right.
you don't have to always be doing something. You just take low exposure, high risk. Just take it easy right now. This is not a time to be a hero, in my opinion.
I agree. All right, Roger. Fantastic conversation with you as usual. Thank you very much for joining me today. Have a great weekend.
Have a great weekend as well, James. Thank you. Bye.